Welcome everyone. My name is Sean Spalding. I am your instructor for Business 120 Financial Accounting. We are continuing on this week with Chapter 2. So again, this week, Module 2, we're basically covering Chapters 1 and Chapter 2. Chapter 2 is going to expand on the accounting cycle, and we're going to start learning about how to journalize entries, post to the general ledger, create our unadjusted trial balance, etc., etc. So first, I want to take a 30,000 foot view, so an overarching view of the accounting cycle. And these are the steps that are involved, and then we'll go back, and that's where we're going to start adding on our knowledge or our ability, our practice of recognizing, measuring, and journalizing transactions, posting them to the ledger, creating our trial balances, our financial statements, closing the accounts, etc. So, as you see here, step 1 is our journal entries. This is where we're going to take a transaction and we're going to properly record it in our journal. And then from the journal, we are able to post to our general ledger. The general ledger is going to come up in MyLab. It's going to look like a T account, and I'll show you what the T accounts look like. But from the T accounts, you'll get a balance, and the balance will go into, or I should say, the balance is going to be for each account. And then each account is going to show up on your unadjusted trial balance. The unadjusted trial balance is really where you're going to see that during that accounting period, your debits match your credits. Okay, that's the most important thing. If they don't, then you've got an error and you've got to go back and figure out what's missing. And then you've got step 4 and 5. Step 4 and 5 has to do with adjusting entries. These don't always come about, but if you have salaries, supplies, things like that, you may need to make adjusting entries because they don't match the accounting period. In other words, your pay period might not match the end of the accounting period, and so you have to make an adjustment there to get the most accurate number for that month or for that quarter. And then step 6, you'll see this is where we prepare the financial statements, and again, that's going to be the income statement, which flows through to the statement of retained earnings, which flows through to the balance sheet. And then step 7, we journalize and post the closing entry. So this has to do with the fact that some of the accounts we have are temporary. So they only are tracked during the period, during the accounting period. And then they are closed to the permanent accounts. And we'll see what that looks like. And then we prepare a post-closing trial balance. This is a pretty straightforward trial balance because it only has the permanent accounts. So it's a little bit smaller. Okay, so that's the overarching view of the accounting cycle. Okay. Now, let's take a look at the accounts, right? So you've got a chart of accounts. This is where you're going to reference these in MyLab. It's going to show you what accounts are in play. And so you've got different types of accounts. You've got your assets, your liabilities, your stockholders' equity, revenue, expense, etc. And then in each one of those is going to have the actual account name. So you'll have, in assets, you'll see a cash account. You'll see an accounts receivable account. Notes receivable, prepaid expenses, land, buildings, equipment, etc. And same thing with liabilities. You'll have your accounts payable, your notes payable, you owe somebody money, and accrued liability, someone's prepaid for a service or something like that. And then finally you have your shareholders' equity or stockholders' equity. This is going to be common stock, retained earnings, revenues, expenses, and dividends. Okay, so that's your chart of accounts. Your chart of accounts is going to have all of the accounts that come into play for a particular business. And this, again, is going to be given to you. Okay? So moving forward, let's talk about, and this is important, obviously double entry accounting requires that every transaction affects at least 2 accounts, right? It makes sense. Double entry. You're entering a debit and you're entering a credit. Okay? And those are going to equal each other. Now, importantly, we need to kind of get over the hurdle here of thinking we know what debits and credits are based on what our knowledge with bank statements or debit cards, credit cards. For double entry accounting, it has nothing to do with those definitions that we might be familiar with. It only means, so debit only means left side and credit only means right side. That's it. It doesn't mean increase or decrease. You'll see that some accounts are increased with a debit, some accounts are increased with a credit. Okay, so again, try to shuffle that out for accounting purposes, and just remember that debit is left side, credit is right side. Simple as that. Now, I mentioned the T account, or the general ledger. So the T account is kind of a shorthand way of tracking journal entries, right? And you see this right here in the center. You would have your account title. So for each of those accounts that we talked about in assets and liabilities and stockholders' equity, they're going to have their own separate T account. And based on what the entry was, so if you had a cash entry for the journal, right, and it was debit $10,000, your T account, the posting to your T account or your general ledger would be $10,000 on the debit side. Okay, and same thing as common stock, you would have common stock here, and that $10,000 would be posted to the credit side. Okay, so pretty straightforward. Now, this particular slide is something that I recommend printing off and carrying around with you everywhere, using it, referencing it for all of your assignments, potentially throughout the semester. It's just a helpful guide because some of these items, they don't necessarily, there's no real logic that you can apply where you could say, oh, well, assets always increase with a debit and liabilities always increase with a credit. You can, of course, memorize that, but in case you don't, it's always good to have this to reference. So what are we looking at here? We're looking at the top, right? We've got the fundamental accounting equation, right? Assets equal liabilities plus stockholders' equity. And then we've got a breakout of the different types of assets, or different types of that fall within those accounts. And so assets, pretty straightforward. It's your assets. And down here, we've got the debit and credit and the plus sign. So what does it mean? If an asset is increasing, you're going to put it as a debit because debits increase. If it's decreasing, it's a credit. Liabilities are the opposite. If you're decreasing a liability, then you debit it. If you're increasing it, it's a credit, and so on and so forth. So you can see how that looks. And this will help you as we move forward to learning about the transaction analysis, which we're going to get into in just a moment. So this is, again, just to kind of illustrate what's happening for the steps 1 and 2 in the accounting cycle. So step 1 is obviously journalize, right? So up at the top, we're given our transaction. Bold City Consulting, Inc. sold $10,000 of common stock to Brian Miller, who was investing cash in the business. So there we have to analyze that and put it into our journal. And then from the journal, we post it to the ledger or the T accounts. Okay, so this ledger here is more detailed than your T accounts because the T accounts is only going to have cash, and then it's going to have a debit side and a credit side. Okay, so let's take a look at the transactional analysis. Now, this is something also that I would print this one and the next slide. Okay, we're given our fact pattern, and then we have to analyze it. Right? We're given the transaction, we have to analyze it and figure out how to properly record it. So, step 1, what accounts are involved? Is it a cash account? Is it an accounts payable, salaries, etc.? That's the first thing we have to figure out. And then for each account involved, which there's going to be at least 2 for each transaction, right? We have to determine what type of account it is. Is it an asset? Is it a liability? Or one of the stockholder equity accounts? Okay. Step 3, is the account balance increasing or decreasing? Okay, so we have to determine based on what we're given, is it an increase? Is it a decrease? So step 4, should the account be debited or credited? And that's going to be determined, and we're gonna go through this analysis together, but that's going to be determined looking at that previous slide I told you to print off that has it indicates for assets, if it's increasing, we debit it. Okay, so you refer to that as you're going through these steps. And then step 5, record the entry and post to the accounts in the general ledger, okay, or the T accounts. So here's another look at it. Step 1, what are the accounts affected? You have to identify. It's cash, it's supplies, it's common stock, okay, whatever it is. Then step 2, what type of account is it? Is it an asset? Is it a liability? And then step 3, is it increasing or decreasing for each of those accounts that are affected? And then step 4, you've got to figure out the debit or the credit, and then journalize it and post it to the general ledger. Okay, so again, just kind of a side note to keep track of everything, we're always going to start off with our debit. So everything in MyLab is going to be the first entry in the journal is going to be the debit entry, and then the second entry is going to be the credit entry. That's just how we're going to enter it. It could be the other way around in some accounting classes I've seen. They do it the other way. It doesn't really matter. But for our purposes, we do the debit first. Okay, so the debit will be at the top of the journal entry, always. So let's apply the transaction analysis. So we're given this fact pattern. Sale of stock. The business sold Brian Miller $10,000 of common stock. So accounts affected. Cash, right? They sold it for cash, and common stock. So we know what accounts are affected here in step 1. Step 2, what type of accounts are they? Cash is an asset, right? And common stock is equity. Okay, so moving on to step 3, is it increasing or decreasing? Our cash is increasing, right? We've got $10,000. The company got $10,000. So it's an increase. And then common stock's increasing as well, right? Of $10,000. So an increase of an asset is entered by debiting the $10,000, and an increase in equity is journalized with a credit. Okay, so pretty straightforward. That's essentially how it works. We can take a little bit of a deeper look here. So this is what the journal entry would look like, right? Cash, $10,000 debit, common stock, $10,000 credit. And you can see a reference to the breakout here of the different accounts. So in your accounts for assets, you've got your T account down here of cash. It's got a $10,000 debit entry, and the common stock's got a $10,000 credit entry. And as you'll see, all these transactions accumulate. There may be some credit entries here, and then you'll have a balance at the bottom. It might not be $10,000, or you might have another $10,000, and your balance would be $20,000. And that's what's going to carry over to your trial balance. Okay. So let's move on to the trial balance and just take a look at exactly what's happening. So you've got your T accounts, right? The T accounts will balance out. You'll balance them, and it'll have a number. For a cash account, it's got a normal debit balance, right? So after all of the transactions are input for the accounting period, you end up with a cash balance of $9,750, and that'll show up on here. And then for each of those accounts, it'll show up. So things to notice here, you've got cash, accounts receivable, supplies, and equipment. Those are all what? Asset accounts. Okay, so all asset accounts have a normal debit balance. So it kind of makes sense that they've got their balance from the T accounts is a debit balance. Okay, and then we've got liabilities next. We've got accounts payable. We've got notes payable. We've got those are what? Liabilities, and liabilities increase with a credit. So typically they're going to have a normal credit balance. And then we have the rest here. We've got some equity, we've got some expenses, and each of those have their own normal credit balance. And that's going to be, again, something that you can reference up in let me pull it up here for you, just as a reminder, this account right here. So this is going to tell you what your normal balances are going to be for those. And again, assets, it's got a normal balance. Down here, you see the balance normally is going to have a debit balance. Liabilities are normally going to have a credit balance, et cetera, et cetera. So the other thing to look at for the trial balance here is that these numbers at the bottom match. If they don't, then you've got a problem. You've got to go back and figure out, you must have missed entering something into either the journal, or you've missed entering something on the T accounts, okay? And then from this trial balance, you can prepare the financial statements, and again, we're assuming there's no adjusting entries, because that could increase. That's going to include 2 other steps if we have to. Those would be steps 4 and 5 if we need to make adjusting entries. But for our purposes here, we don't. So we do have to create the income statement first, the statement of retained earnings next, and the balance sheet. And let's look at why. The income statement is up here. It's going to give you your net income or loss. That's going to flow through to your statement of retained earnings down here, which is going to give you your total retained earnings, and then the retained earnings is going to show up on the balance sheet. Okay, so that is, in a nutshell, kind of a guide to the important parts of Chapter 2. If you have any questions, let me know. You can always email or message me. All right. Thank you.